On May 6, 2026, the market didn't need another AI investment headline to move higher. The real momentum came from liquidity. Treasury issuance, reserve management, lower oil, and renewed semiconductor strength all aligned to give risk appetite more room to breathe. The Treasury's latest refunding announcement provides stability by keeping nominal coupon and floating rate note auction sizes steady. By coupling this with active buyback operations, the Treasury has established a controlled supply backdrop. This prevents fresh upward pressure on long-term yields, which is a key technical support for risk assets, functioning more like a mechanical constraint than a traditional policy rate cut. Equities care about that plumbing because bond supply and reserve pressure can set the ceiling for valuations. When issuance pressure looks contained, buyers are more willing to pay for growth. The message was not that policy guarantees a rally, it was that the market had one less macro headwind. Oil prices gave the market set up another push today. Brent crude fell sharply after Iran signaled the Strait of Hormuz might reopen, which pulled energy stress away from the worst-case scenario investors were pricing in. While this relief helps growth stocks, it has not erased the underlying geopolitical risk. It simply bought the market more time. Semiconductors confirmed that buyers were still willing to take risk. AMD's outlook kept the chip complex moving, and the broader semiconductor sector rallied again. The shift in framing is that chips were no longer the entire market story. They served as confirmation that liquidity relief was reaching the tape, giving risk appetite room to breathe. But a structural risk check is surfacing in credit markets. HSBC has taken a roughly $400 million charge linked to a securitization exposure. The bigger question here is not the loss itself, but whether the due diligence processes that underpin private credit are finally being stress-tested after years of easy funding. To be clear, this is not a market crash signal. The real risk in private credit is less about sudden, dramatic headlines and more about a slow freeze in the financial plumbing. Markets can look perfectly calm here until liquidity is genuinely tested. If major lenders start tightening standards or prioritizing cash over new loans, the pressure builds gradually through reduced credit availability rather than a single explosive event. AI remains a pillar of market sentiment, but it wasn't the primary engine today. While reports of a massive Anthropic commitment to Google Cloud underscore that enterprise demand is very much intact, and hyperscaler revenue growth continues to justify the heavy infrastructure spending, the market shifted its focus. Today was about liquidity first, with AI initiatives serving as important but secondary follow-through. Apple offers a clear lesson for investors. Under Tim Cook, the company's focus shifted from pure invention to operational discipline, leveraging supply chain scale, growing its services business, and prioritizing significant capital returns. For shareholders, this demonstrates that mature megacaps do not need to mimic the growth trajectory of startups to create lasting value. Europe remains the global weak spot in this macro landscape. With its heavy reliance on energy imports and massive industrial exposure, the region is fundamentally more sensitive to oil price swings than the US. Should energy stress return to the markets, Europe is where the macro damage will likely show up first. When we look at the economic relationship with China, the risk goes well beyond the military dimension. It is fundamentally industrial. The trend is moving toward a more predictable, gradual decoupling. While that approach helps avoid sudden, jarring market shocks, it still creates a persistent drag on valuations. Investors should prepare for the realities of this new environment: sector-specific tariff risks, continuous supply chain reshuffling, and structurally higher costs for critical goods. To keep this supportive backdrop in perspective, watch for these 3 tripwires. First, monitor 10-year Treasury yields for a move back toward the stress zone. Second, watch oil prices, where any reversal from recent lows would signal renewed energy pressure. Finally, track whether private credit headlines translate into actual lending restraint. These structural signals matter significantly more for your outlook than a single positive day in the markets. May 6th was not just another day for AI. It was a liquidity story, with chips serving as confirmation. Treasury supply pressure stayed manageable, oil cooled, and risk appetite broadened. Looking forward, the question is whether this supportive setup can survive a tougher credit shock or a sudden energy headline.